All right, today we are going to pull back the curtain on one of the most powerful tools in the world of finance, the futures contract. Now, whether you're talking about protecting a business or making a big speculative bet, futures are really all about one thing, managing uncertainty. So, stick with me for the next few minutes, and I promise you'll get exactly how these things work.
So let's start this off with a bit of a puzzle. What in the world could a coffee farmer have in common with someone who's about to buy a house? I mean, they seem like they're from totally different universes, right? But they actually share this one fundamental concern, and it gets right to the heart of why futures contracts were even invented in the first place.
And that answer is uncertainty. Simple as that. Both the farmer and the home buyer, they're totally exposed to the risk of prices changing on them down the road. And a futures contract? Well, it's a really elegant tool designed for that exact problem, managing that uncertainty.
And look, we're not talking about some casual handshake deal here. This is a legally binding contract. The whole point is that you are locking in a price today for a transaction that's going to happen on a very specific date in the future. It basically lets you take all the guesswork out of what tomorrow's prices might be.
Okay, so how does this thing actually play out in the real world? Well, the first major use is for something called hedging, which is really just a fancy financial term for protecting yourself against risk.
Let's go back to our coffee example because this is perfect. For the farmer, the dream scenario is that coffee prices go through the roof. But that same dream is the coffee shop owner's absolute worst nightmare. And if prices crash, well, the shop owner is ecstatic, but the farmer could literally go out of business. See? Their financial interests are polar opposites.
And this right here is the magic of the futures contract. The farmer gets to lock in a price that guarantees a profit, and the coffee shop gets to lock in a predictable cost for their beans. They've taken the wild roller coaster of price swings completely out of the equation. Now they can both run their businesses with some certainty. You know, this isn't just for big companies either. Imagine you're planning to buy a house next year, but you're really worried that mortgage rates are going to skyrocket. Well, you could potentially use an interest rate future to lock in a rate today, protecting yourself from that uncertainty.
But here's the thing. Managing risk? That's only half the story. The other side of the coin, and the second major use for futures, has absolutely nothing to do with protection. It is all about pure speculation.
So, unlike our coffee farmer, a speculator isn't trying to avoid price changes, they're trying to profit from them. They use futures to make bets on whether the price of gold is going up or the price of oil is going down. And the beauty for them is they can do all this without ever having to find a place to store a single gold bar or an oil barrel.
And this brings us to a really critical warning pulled directly from the source material. Speculating with futures is an incredibly high-stakes game. If you bet wrong on which way the market is going, your losses can be fast, they can be huge, and they can even be more than the money you started with.
So, how do these agreements actually work on a technical level? To get that, we need to look at the anatomy of the contract itself. It turns out every single futures contract is built from 5 standard, totally non-negotiable parts.
These 5 specs are what we call standardized. It means whether you're trading a contract for crude oil in New York or in London, every contract for that asset has the exact same terms. This uniformity is absolutely crucial. It's what lets them be traded so fast on an exchange because everyone knows exactly what they are buying or selling.
Let's just zoom in on one of those for a second. Contract size. This part is set in stone. It never, ever changes. So for example, one contract for crude oil always represents exactly 1,000 barrels. One contract for gold is always 100 troy ounces. No confusion, no ambiguity.
Okay, so that brings up a good question. How much is one of these contracts actually worth? I mean, if you're trading a contract for 1,000 barrels of oil, what's the actual dollar value of that position? Turns out there's a really simple formula to figure it out.
It's super simple. You just take that standardized contract size and you multiply it by the current market price of the asset. And that gives you what's called the contract's notional value. Think of that as the total value of the stuff you now control, not the amount of cash you actually had to put down.
Let's make this real. Here's a popular stock index future. Its contract size is a multiplier of $50. So if the index is trading at, say, 2,250, you just multiply those two together and you find that one single contract represents a notional value of over $100,000.
And that massive number leads us right into the most powerful and, frankly, the most dangerous part of trading futures. Because here's the real kicker, you don't actually need $112,500 to trade that contract. You don't need anything close to it.
And this is where the mind-blowing power of futures really comes into play. To control a $50,000 position in crude oil, you don't need 50 grand. Instead, you just have to put down a small, good faith deposit. It's called an initial margin, and it might only be a few $1,000s.
I mean, just look at the difference on this chart. That tiny little bar on the right, that's your margin deposit. And it gives you full financial exposure to all the price moves of that giant bar on the left. You are controlling the whole thing with just a tiny fraction of its value. That is the definition of leverage.
Now, the most important thing you have to remember about leverage is that it is a true double-edged sword. Yes, it can magnify your gains in a really dramatic way, but it works in both directions. It will magnify your losses just as powerfully and just as quickly.
So let's wrap this all up. At their very core, futures contracts are about locking in a price to get rid of uncertainty. They can be used as a shield, right, by hedgers to reduce their risk, or they can be used as a weapon by speculators to bet on which way prices are going to go. And the engine that powers this whole thing is leverage, using that small deposit to control a massive position, which just turbocharges both your potential profits and your potential losses.
And that kind of leaves us with a final thought, doesn't it? The futures contract itself, it's just a tool. It's neutral. In the hands of a farmer, it's a shield to protect them from the unknown. But in the hands of a trader, it's a sword used to battle for profits in the market. It's the exact same instrument, just used for two totally different goals.